Hi, this is the first of the private newsletter/videos that GoldSilver.com customers only can get. However, the first several of these, until we reach a blow-off top, until gold and silver are maxing out in their value, we're going to make some of these available to the public so they can see what we are doing several weeks after you get a chance to view these. One of the values that we think that we can provide that no other dealer can provide is that we are all invested in gold and silver. We're on the same side of the fence that you are. It's in our vested interest to try and figure out exactly where the top is and to sell our personal investments at that time. And what we're going to be doing for our customers, we're going to be measuring this for ourselves, and then we're going to let you know what we are doing. And the thing is, a lot of people will say, well, when gold hits $2,500 or when it hits $5,000 an ounce, I'm going to sell. But they're missing the point that price means absolutely nothing. When you talk about a price, you're using the dollar as a measuring stick or some other currency in the world as a measuring stick, and all currencies are falling in value. They are not a store of value, so you can't use them to measure anything. Price means nothing. Value is everything. $2,500, $5,000, those might be good figures for gold's peak if we go into a deflation. If we go to a big inflation, it could be $30,000 or $10,000, $15,000, $30,000, who knows? If we have hyperinflation, it is perfectly logical to have gold prices measured in billions, trillions, or quadrillions. The whole point here is currencies are a very poor measuring stick, and it doesn't matter which currency you're using, but gold is measured in US dollars, and the US dollar keeps on shrinking in purchasing power. That is the reason that prices go up. It's not because the stuff went up, it's because the currency went down. So you need some other measurement of value, and one of the best is measuring things with gold and silver. At GoldSilver.com, we have a team of researchers and myself, and what we're doing is every day we're trying to figure out what the value is, and we have a proprietary basket of indicators that we're going to be using that measure gold's purchasing power. And so we should be able to measure where the top of this market is. And then we've got some confirming indicators, some other indicators that we use that have to sort of flash a sell signal once we get into these overvaluations on the main basket of indicators. And I can't tell you what the whole basket is or what the confirming indicators are, but I can tell you a few of them. And basically, a couple of them are the gold Dow ratio, which you have seen before, most likely, and real estate, a single-family median price home measured in gold. So instead of pricing these in dollars, we're going to price them and value them in ounces of gold. If your house goes up in price, but it purchases less food, less gasoline, pays less for water and power, or shares of stock or ounces of gold, that means it's actually fallen in value while it's been going up in price. Same thing for stocks. And for stocks, one of the best measurements is the Dow, which is a basket of 30 different companies. It's the largest industrial companies in the United States, the Dow Jones Industrials. And they take this index of the 30 companies. What we do is we take it and we divide it by gold, and you've probably seen this before from other sources also. But basically, when you price and value the Dow in gold, what you see is that it has a mean average of about 4 ounces of gold. And if you start back in 1900 up to 1929, got out of whack, it went into a bubble to 18 ounces of gold. However, that was just the stock market moving. It was stocks moving, but not gold. Gold was $20.67 an ounce. Then the markets crashed, and it reverted past the mean down to just 2 ounces of gold in 1932. Then we went up in 1966 to about 28 ounces of gold. And then the stock markets went sideways, but gold began to move because it became free trading in 1971. and the market reverted, and the Dow went all the way down to just 1 ounce of gold. That means that on the same day, the Dow and gold were the same price, the points of the Dow and the price of gold. Then it went from 1 ounce of gold up to 45 ounces of gold in the year 2000, and it's reverting now. It's back down to 8. The mean is 4, but because we're in a larger bubble, remember it was 18 back in the 1929, 28 in 1966, and then 45 in the year 2000. The more out of whack it is, when it was at 18, it went to 2. When it was at 28, it went to 1. It was at 45 in the year 2000. It's probably going down to about a half an ounce of gold, meaning there will come a day where the price of gold is going to be double whatever the points of the Dow is. Now, it's possible that in a deflation, it may only go down to just 2 ounces of gold. In a big inflation or hyperinflation, it might go to 1/10 of an ounce of gold, meaning the price of gold would be 10 times the Dow. We don't actually know this, but we do have other indicators, these main indicators, gold's value measured in stock and gold's value measured in real estate. Those are going to tell us when we're getting into a caution zone, and then where we're into an overvaluation where it should normally be sold. But there's some other things that you have to watch. What's going to happen with the dollar? What are exchange rates doing? Bonds. All of these things have to be watched and sort of simultaneously read, and then you've got to sort of try and make a prediction of what is going to happen, where the top is. Because if currencies do start to fail and people rush back toward gold and silver versus the dollar, I mean, prices could really go astronomical. But the thing is, you have seen that Dow-gold ratio before, where the Dow is measured in ounces of gold, but you're measuring the value of stocks with gold. If you flip that around and measure gold by how many shares of stock gold is worth, then you get the opposite, where you're measuring how much purchasing power gold is. And if we do a chart on that, what you see is that from 1980, gold went down, and it's just coming off the bottom, and it should continue rising up to where it was and probably go further. But this is going to make a nice little basket that you can then load real estate and stocks into. But the silver Dow ratio, when you look at that, that went like straight down, and it's coming off of this bottom, and it's barely even started to move up. Well, it's going to rise just like the other side. If you flip these charts around, you'll get a symmetrical idea of what this chart is doing. But because silver is more rare this time around than it was during the bull market of the 70s, and because there's a greater percentage of the world's population that could invest in gold and silver, it was only 10% of the world's population before, just North America and Western Europe, and because everybody has 10 times more dollars, and because people have an investment mindset now. The average public did not have an investment mindset back in the 70s. You've got 10 times more people that can buy it, each with 10 times more currency, and in every population, probably somewhere between 10 and 100 times, maybe even greater, more people that have an investment mentality, that are looking for that next place to store their value that's going to protect their wealth and grow their wealth. If you look at the Soviet Union back in the 70s, there wasn't anybody there that could buy gold. There were no markets there. China, under Mao, they couldn't buy gold, and there were no markets there. The price of gold in the 70s was set on the Commodities Exchange in the United States and the London Metals Exchange. That was it. So it was North America and Western Europe. The rest of the world was excluded. This time it's everybody. And this time currencies have a problem. So I believe this silver ratio that I was talking about, silver Dow ratio, is going to fall, and then it's going to go up, and it's just going to, I mean, in this studio we've got a very high ceiling, a 10, 12-foot ceiling. This thing is going to go through the roof. So it's going to look like this giant ladle that you can then scoop up real estate and oil wells and stocks. You'll be able to go into the next investment class, and what we're going to do is help you figure out where that is. I mean, we can't guarantee anything, but we only win if we can pick the top of this. Anybody that says they can nail the absolute top, they're lying. If they do pick the absolute top, they were lucky, and that's all it is. But we are planning on easing out, probably like in 20% increments, sort of around the top. And we'll be measuring this and letting you know. What we do know is that real estate is still in a bubble. Based on one of the best ways to measure real estate is the mortgage rent ratio. And so how much would you pay for a house? How many dollars would you pay for a house for each dollar in rent that you can receive? And right now we are coming off the biggest bubble in history. The bubble back in the 1989, 1990, it was about $1.25 that you were paying on a house if you were taking out a 30-year mortgage. You were paying $1.25 for each dollar's worth of rent. And then when that bubble popped, it blew past the mean. It should be right around $1.05 that you pay for a house for each dollar you can rent it for monthly. And it blew past the mean and it went down to 0.9. So that means on a national average from 92 to about 95, real estate cash flowed, single-family median-price homes cash flowed by about 10%. But nobody could get a loan. Credit was hard to come by. The economy was in the dumpster. So nobody was buying them except the people that were positioned right. And we hope that we can help position you right. But then we went into the biggest bubble in history where this real estate mortgage rent ratio went to where people were paying $1.85, $1.90 for $1 in cash flow. It was insane. Now it's reverting. It has come down to the level of where we were in 1989 at the top peak of that bubble and bounced, and we're still not below the bubble of 1989. It's seeking equilibrium. All markets seek equilibrium. They have to. It's seeking fair values. And so it has to fall until the mortgage rent ratio is where it has been historically. And because it's coming off the biggest bubble in history, it's probably going to blow right past the mean. And you're going to see cash flow like crazy, where real estate is going to cash flow. The single-family median-price home on a national average may cash flow at 15, 20%, 25%. Who knows? But by measuring, this is one of the indicators that we're using to show whether or not these markets are over with. Another one, every currency on the planet. There is no culture or country or currency that is safe from the US dollar. If the US dollar catches a cold, it is contagious. And if it catches a cold, the rest of the world will get sick. Except this time, I don't think it's just a cold. I think the US dollar has cancer. This isn't going to be pretty when it happens. I am not an end-of-worlder or a doomsday guy. All you can do is play the hand that you are dealt. And if this does happen, and I believe it will happen no matter what we do, because it's just all this energy that has built up being released, when it happens, it's not going to be good for most people. It's only going to be good for a few, and those are the people that hold gold and silver.